hyper-personalization is something I hear more and more. One single card, one customer, the benefits should match what they specifically need. And, you can't do that without data. All the processors can provide the data, but the difference is, do you have data today or do you have data in 30 days, batch process, right? I think the other thing a lot of people don't realize is that it's not just about having the data and making those decisions, but having the data in a very, very timely manner and being able to make decisions and pivot very quickly.
Welcome back to the Issue Academy. Today we're diving into one of the fastest growing, yet historically slowest to change parts of financial services, credit. From BNPL and embedded lending to tokenized credit experiences and instant decisions, the industry is finally breaking out of a 50-year freeze. A huge part of that shift is the emergence of modern credit engines, including new solutions like Paymentology's Pay Credit, that finally gives fintechs and digital banks the flexibility today's customers expect. To explore where credit is going and why it's changing now, I'm joined by two people at the center of this evolution. David Schipper, Strategic Advisor, Retail Banking at Datos Insights. Rob Macmillan, Group Product Manager at Paymentology. Welcome, David and Rob.
Thank you. Thank you.
Let's dive right in. David, you spent years analyzing how consumers use credit, from traditional cards to installments, BNPL, and basically everything in between when it comes to credit. What first drew you into studying lending behavior? And how has your understanding of credit really evolved now with the emergence of digital banks and how they're reshaping the industry?
This is a great question. Thank you. So I have been studying lending for a while, and I've also worked, even before Datos, I worked in banking for a long time and managed a lot of different products. And, I think back very early, maybe 15, 20 years ago, managing like consumer direct loans in the US. And knowing that we have an auto loan here that no one gets because you have to come into the branch, you have to know what car you're purchasing, you have to fill out a form, you have to, the banker keys everything in, and then 2 days later you find out if you got the loan for the car that you wanted to buy. And no one got it because you can just go to the dealer, and the dealer instantly has access to 5 banks and can give you a loan immediately upon the purchase. And really the only time we ever sold those was when people were refinancing their own automobile or needed cash out. And so, we had a product that we knew nobody wanted because the process to get it just didn't make sense, right? And so you fast forward and you go, from everything's paper, and I've managed cards, I've launched card programs, and banks in general they were lucky because consumers couldn't go very many other places, right? And so nowadays you have, it's changed so much even in the last few years, but neobanks, fintechs, they are taking what banks have always done okay and really making it very smooth and changing the way that consumers, really changing the consumer expectation on, maybe 5 or 10 years ago, it was okay. I would apply for a credit card. I would get a credit card 7 days later. Right now I apply for a credit card, and not only am I applying, but I'm only keying in maybe 3 or 4 pieces of information. I'm getting approved. I'm getting a card. And so we're seeing that in our own Datos research when we do a consumer study. For example, and it's different by country, but we always think that with a credit card, rewards is one of the most important things, and it is. But what we find is a convenient application is equally as important to the decision for choosing a credit card. So everything has changed, and all the challengers have really forced banks to react. And so it's really interesting to have watched that evolution from, 2 or 3 days is okay, to instant is, preferred, to now it's an expectation. Not only instant, but it should also be very, very simple to get.
Absolutely. I think optionality is key, but and we see this a lot with digital banks, they are really helping to drive the innovation. Because I think at the heart of it, they really understand what consumers are looking for. They have such a deep knowledge of their customer profiles and what customers need, that they are basically saying they're no longer going to just accept, the status quo. They're going to challenge it at every stance. So that's really interesting for credit. And that's obviously why we're seeing this evolution happen now.
Absolutely. Yeah.
And actually that takes us into the credit revolution, right? So let's take a deeper dive into what's driving this shift other than digital banks. Because credit issuance is projected to reach over $1 trillion by 2030. But what's more important, like we said, is how consumers want to actually use credit. Whether it's instant approvals, flexible pay later options, digital issuance, but it's all about personalized decisions, right? And the experiences need to be embedded directly into apps. Like you said, so customers have that flexibility immediately. And if you look at it from a digital banking perspective as well, when neobanks first launched, debit was the low risk, low barrier entry point, right? So everyone started with a debit product. But now that market is incredibly crowded. A debit card and a slick app no longer means, real competitive segregation. So this is where we see credit really driving that innovation with digital banks, and they're offering real value, right? And credit can really bring that value directly to the customers. So when we look at what does credit bring, it brings in personalization or hyper-personalization, instant issuance, and then for our actual issuers, of course, it brings in that additional margin, right? And David, Rob, we were just talking about, how digital banks now are actually going for, a profitable model from day one, right? Which is now the key to driving a successful digital bank. So David, can you shed some more light on what's really driving credit from the consumer perspective and in digital banking? So what are these digital banks doing differently?
There's a few things happening, right?
Yeah.
And the digital banks you're right. They understand the consumer, and not just, they understand that consumers want things very simple and they want an easy application, but they also look at a broader, kind of more broadly than that. And what are their lives like? What are they doing on a day-to-day basis, right? They're often on their phones. I mean, they're looking at the way that consumers behave in general, and they're creating or building products around that. So not just a simple application and not just getting everything immediately, but also having access to data, having more control in their hands to be able to maybe unsubscribe from a service that they're struggling to maybe unsubscribe with the merchant, or having an analysis of their finances, because all of those things are really, the neobanks, challenger banks are really focusing on what the consumers not only want and say they want, but also what they need and maybe don't even know that they need, right? So maybe obviously displaying your credit score is pretty common, and breaking down your transactions is pretty common, but how can you go one step further from that and teach them about their credit, or notify them at a very timely manner, make recommendations to them? Building all of this other functionality into the app is really changing the consumer expectation in a way that's much different. Yes, I have a card. It provides access to credit. I get rewards, or I get cash back, and I can make purchases, but also it's really leading me in the right direction to have, to make better decisions, to get discounts where I might not have known where they existed. And, I think what's great about neobanks and challenger banks is they're looking at all the bank products and they see everything that's good and they're copying that. But then they're also looking for, okay, well, how can we test and learn with this item? Or how can we, pull in this unrelated feature or functionality or expectation into the application? And that's really what really in a lot of ways allows them to do that, is the platform that they use also. Because banks, a traditional bank on a legacy platform really can't react that quickly. And it's really spectacular to watch how the neobanks, challenger banks, new credit card programs are changing not only customer expectations, but forcing banks to change as well. And they're really leading the way, right?
Absolutely. I think two things that you pointed out was data. So the data points are very different, because in lots of cases, these are first-time consumers who have access to credit. And so using different data points to actually build out their credit history, or thinking differently about, okay, who is this customer, right? How do I build out a credit history that makes sense to them, while also making sure that the products make sense to that consumer? So that is absolutely key. And the second that I really like is a holistic view of the customer, because we all know, yes, credit and loyalty are linked, but there are so many other facets to what credit can enable. And if you look at like small, like we call them micro SMEs, right? The influencer on Facebook who needs, or I shouldn't say Facebook, I'm revealing my age, but it's really about saying like, how do we create even like credit cards for expense management for micro SMEs, right? So it's really looking at who is the customer. And I think you're right in saying banks have always taken it for granted that we'll give customers a product, and because it's their only option, that's what they have to stay with, right? So it's so interesting. Rob, I want to tap now into you because what's your perspective from the issuing processor side, and what gaps have you seen in the market?
Okay. Well, firstly, I think David's covered it very well in terms of a lot of the evolution of the market, and it is an evolving market. And to a certain extent, one of the drivers there is how do these organizations leverage what's happening in the market? So, what happened with the buy now, pay later providers and everything else. So they need to try and participate in there. But what that does imply is that from a system point of view, an infrastructure point of view, you need to have solutions which support this. And one of the complexities there is that traditionally, a lot of the solutions that have been available, as David has always mentioned, legacy systems, they're designed kind of for like the one size fits all capability. Yes, great at volume, but in terms of features and personalizations, it's going to be more of a gap. And that's what we've been looking at in the market to say, okay, in this gap, what do we need to do to enable our clients, digital banks, to offer this, not just the digital first experience, but to give something to their customers that's going to be product and credit product features which meet their needs. And the needs vary. So it's not just having something that is the same for everybody. You want to be able to vary it, and also to enable it to evolve, because what you launch today will be on customer feedback, different customer segments you're going to target. It's going to evolve over a period of time. And that gives rise to then saying, okay, in this infrastructure, what components do I need? And the components I need, they're going to need to be able to manage credit ledgers, of course, because that's the core capability. But you'll need to have this flexibility to say, okay, I'm going to have different features for my different customer segments, and they're going to have some choice in how that works. And that's been a key focus of what I've been doing.
Yeah, and absolutely spot on. I think choice, flexibility, being able to pivot are absolutely critical to modern credit engines, right? So it's absolutely key. And now let's look at, building for modern customers, right? What does this really mean? When we talk about, designing for, the new generation, because we've seen a generational shift unlike anything before, right? Gen Z is credit conservative. Like you said, they're digital first. They expect decisions in seconds, everything instant. But at the same time, older customers using credit in a more strategic way, right? If you look at embedded finance, it's really turning credit into more of a feature rather than a standalone product. David, how are different generations redefining what good credit looks like?
So I want to, what you both mentioned, personalization. I just want to touch on that real quick. And I know, not to back up, but the hyper-personalization is something I hear more and more. A customer of, one single card, one customer, the benefits should match what they specifically need. And, you can't do that without data. And the access to data through the card is, all the processors can provide the data, but the difference is, do you have data today or do you have data in 30 days, batch process, right? And I know that's a little off your question, but I just wanted to make sure and bring that up because I think the other thing a lot of people don't realize is that it's not just about having the data and making those decisions, but having the data in a very, very timely manner and being able to make decisions and pivot very quickly. So
that's a great point because real-time data analytics and being able to make decisions in real time is all dependent on the data, right? And I think this, again, historically, banks have always had the data, but they haven't used it at all or efficiently or timely enough. So that is a great point.
So I think what's driving credit right now is it's been interesting because financially speaking, it's different in every region, but there was a period of time, and we're I feel like kind of in some ways getting out of this. People were using credit as a necessity. And that was, okay, I need to have a little bit of access to extra money because things are tight, and this is going to help me get by, and I plan to pay it back. And so far, I think in most regions, they are paying back very well. But now it's shifting to where they still need access to credit, and they want to keep that open. But like you said, it is very strategic. So it's going to be for a specific purchase, or it's going to be as a money management tool so that I can make sure I don't overextend my existing deposits and I get rewards or cash back and all of these things. So what I think now personally, and just when I look at the data, what I think now is driving the credit and the new credit cards that are being issued is this understanding that I, at some point, am going to need access to money, right? I will not have enough for some purchase, some emergency that's going to come up. So I need to build my credit. I need to have this access to credit sitting around. Credit card to me is the perfect credit product because you always have access to it, and it's very simple and easy to use. So I think what's driving a lot of it now is just the fact that consumers know that even if I don't need it today, I will need it. And having it is going to, by building my credit history and credit score, is going to mean that in the future I have access to even more credit, And so it's just this money management tool combined with a future looking like financial planning type product, if that makes sense.
Yeah, absolutely. I mean, when you look at it, right, a lot of consumers are more financially savvy, so they understand that they have to build up this credit history, but they're doing it in more creative ways. And the other is control. This is where we're really seeing credit push that needle, because what we're seeing is, a lot of the younger generation are really saying, how do we control how we use our funds? So for example, we have a customer in Hong Kong, and we were just talking about it, Marks by Standard Chartered, and they have their dual flip card where a customer can choose, okay, for high value spend, I'm using debit, low value spend, I'm using credit. And the fact that customers want that optionality and that flexibility just shows how aware they are of where they want to manage their actual funding. So it's so interesting. Rob, I want to get your perspective, because obviously with these generational shifts and, issuers needing more assistance, how does this change what issuers need from a processing and credit infrastructure perspective?
Yeah, no, it certainly it has a big impact. And we've talked a bit about configuration already and flexibility. But I think if I put it in the context you just said, so great, I have an installment plan capability, but what I really want to do is offer my customers some choice. So actually, yes, I've done a transaction, but instead of just saying, oh, okay, I can convert that into a fixed installment plan of 6 months or whatever, you might want to give them the choice to say, well, actually, it could be 3 months, it could be 6 months, or it could be 9 months. Or maybe you choose not to do it at all. Or as you said in the flip card example, maybe you're going to pay from a different source. But once you've offered that, it doesn't really stop there. You're also helping them to try and manage their finances. So you want to make it very visual, easy for them to understand. They may have more than one installment loan. This is where they have, but then give them choice to say, oh, actually, maybe you can aggregate it. Maybe you can say, actually, I'm going to aggregate these 3 things together, and I'm going to change my plan. Maybe my circumstances have changed. I'm struggling a little bit more. So I'll actually put them together. I'm going to spread them now over 12 months. And that's great from their point of view. You're managing their finances and it's being responsive to their needs. But it's also good from a client's point of view, because the client, one of the problems about credit offerings is the problems of credit risk, managing that risk. You're much better in a position where you're offering your customers the choice to go and spread their payments, and you're then getting data from that. You're understanding their repayment trends, the data which is helping you make better decisions to enable your customer. What this really comes to at the end of the day is you're building an engagement with your customer. It's not just you've given them a credit card, they're using it, doing some convenient spending. You're actually really helping them. They're looking at checking where the money's going, seeing what their projected spend is. Maybe you're helping them, actually, we can change that loan now. Maybe you can pay it off a bit quicker and reduce some of your costs.
Yeah.
It's better at building engagement.
And actually, that is such a fantastic point, because the reality is, and I think there was a study done by MasterCard about 2 or 3 years ago, just post-COVID, where they did a study to say, okay, what is customer loyalty like? As in how much they willing to stick with their existing financial provider versus switch to another bank that has better feature services, rewards. And it was 75%. So 75% of consumers said, actually, they're willing to jump if they get a better service somewhere else. But Rob, in this scenario, using this data and for banks to have this ability to say, you are my customer, this is what I want to offer you because you are important, I understand you. Having that is actually going to rebuild that consumer loyalty with banks,
Yes.
which is an absolutely incredible, additional benefit, basically.
It is.
Yeah.
It is. And it is also data for the bank themselves, because a bank is a business at the end of the day.
Yeah.
Their role, as you said at the beginning, is this is an opportunity to engage with customers, but you're also looking, this is how you generate your revenue. And one of the things you're very conscious of is there's credit risk involved. You're worried about defaults. But if you're providing these additional services and you're collecting data related to them, so the propensity of people to make that choice to convert a purchase into a loan, their ability to keep up with their repayments. This is all collecting more information, which is feeding to better decisions on your side. So actually, you're going to be spotting those trends in terms of potential delinquency. So you can actually take action. People don't really want their customers to get into a delinquent position. They definitely don't want to end up in a write-off. So actually, that data and the source of that data, which is part of where we go with our products, is key for our clients as well.
Absolutely. I want to now look backwards. Let's take a bit of a step back. I want to talk now about legacy constraints versus modern expectations, right? Behind the scenes, many issuers are still relying on legacy technology, hard-coded products, and no real-time decisioning. With, one of the things that we see a lot is months-long change cycles. David, can you share some real examples of how legacy systems are holding back product innovation?
Absolutely. So, I've been with Datos Insights now for 5 years. And before that, I worked at multiple banks, probably going on about 20 years total. But, one of the best examples, and I use this a lot, I worked at a small bank in Missouri in the U.S., and we launched a credit card. They had never had a credit card before. So launched a credit card, went with, I'm not going to name who, but we went with a legacy provider, what you would call a legacy platform. And, you get a stack of papers you get about 100 pages of papers of settings that you have to go and select. And in some cases, you don't know what you're selecting, and neither does the provider in some case. Like they're like, well, we don't know exactly what that does, but here's what other people have chosen. So you go through this process, and then 6 to 9 months later, you have a test card that you can use, right? So this is a long process. And I will say legacy platforms are workhorses, right? They work, they do work. But in that experience alone, it was such a long cycle just to get to a product. And then once you launch the product and people start using it, you realize, oh, well, here's a setting or here's another setting that we chose, and this doesn't do what we wanted to. So you submit a form, and 2 weeks to, 3 or 4 weeks later, that a change is made. And so now things are fixed. So all of that was the experience with launching the product. But then soon after that, Apple Pay was announced. And big deal, right? Although usage was nominal at the time, every bank in the country, talking about the US, probably around the world, wanted to have this capability. Customers were demanding it, even if they didn't have an iPhone, so everybody wanted it. And we were like, we have to have it. And well, at the time there was a limitation because a lot of large providers have multiple platforms and they have to prioritize which is the most important. So it probably just to get Apple Pay took another year.
Wow.
Yeah, because it had to be, prioritized, and it was a project. And, I think about that now, and I think about things that are a lot more modern and next generation. And I don't know how long it would, if Apple Pay happened today, I don't know how long it would take for anyone to have it. But my guess is it could be done theoretically in weeks or months, right? Not a year. So that really to me is still the issue with a legacy COBOL-based platform that has to be programmed, that has to look, there's no, they have to look and say, okay, well, how is this going to impact this? And how is it going to impact this? And then suddenly they're changing everything and they're testing. And that's the experience with a legacy platform. And that's what, no matter even if you launch today, for the most part, this is going to be your experience, right? So it's really not what you need. It's not just about what you need today, and they can provide it. And it might take, a lot longer. It might take 6 to 9 months to launch that product. But then going forward, you have no idea what innovations are coming, but you will know that if whatever comes next, you'll be a late adopter. You're not going to probably create anything new. And if you do want to create anything, you're going to have to pay for it and have a project, and then know that provider is going to resell it to everyone else, right? So it's really about the ability to react to market changes. It's not just the ability, okay, today I know I want a credit card that does all this. Maybe they can help you build that. It's about what comes in 6 months or a year, what's announced. It's going to be very difficult. And that's the limitation, in my opinion. The biggest limitation if on a legacy platform is that ability to react, the ability to create something new. You're very, very limited.
Yeah, absolutely. I think that ability to future-proof cannot be stressed enough, right? And unfortunately, because I think with a lot of these legacy platforms, they just need to get it done. They just need that spec to be completed, and because it's taking them such a long time, they don't have the luxury to say, okay, let's be innovative. They're really just trying to plug a hole, right? And, Rob, I really want to get to your side. So what are the biggest limitations digital banks face when trying to offer these flexible modern credit experiences?
Well, I think the limitation, especially comes from if there are any choices of legacy systems, is basically they may have all the great ideas in the world in terms of what they're about to launch, but they're just going to be held back.
Yeah.
Not just as Dave was saying in terms of, it's going to take a long time to do this feature, but the whole idea is you're probably going to evolve that feature. So it's not just getting it into market in the first place. You're probably going to want to change it. You're also going to be wanting to make sure that it's compliant with regulation. And a lot of the time scales of the old systems, it might take a long time to test things. So whatever platform choices you're making, you also need the ability to bring it to market quickly, which means you need to be able to test it, validate it's compliant, make sure all the calculations are correct before you launch it to market. And then if you're now in this position, you're looking around for different options. One of the problems you're probably going to come across is what sort of alternate options are there available? Yes, there are more modern, maybe some of the core banking providers that got into this market, and they've launched on the back of their great debit card program. So they're innovative, they're great. But if you then want to move into credit, you're going to get into a slightly more complex area. One of the things we've definitely found is, yes, I've got a debit card platform. I can have some credit capability in terms of like an overdraft facility, but actually I want to do something a bit more innovative in terms of how a card works. I want to have different interest rates for different types of transactions. I need to create fee structures which related to this. I need to manage billing cycles. And I need to do installments on transactions. And there aren't really many systems that support that, certainly not in a modern digital way. And as I said, the challenge for the digital bankers is going to kind of hold them back. They're not going to really achieve the outcomes they want for their customers because they can't really move quick enough.
Yeah.
Right.
It's just not fit for purpose, right? It's very much square peg, round hole. We have something, let's try and make it fit. Yeah. And a lot of these, and this is what we're seeing, this is what we're hearing from our customers. And they're saying, look, they tried to start a credit program, but because it was built on legacy debit infrastructure, it just didn't work. And like you said, David, they could not pivot or, have any kind of innovation because it just wasn't built for it, right? And now this takes us to the very exciting part of this podcast. We're really looking at removing friction, unlocking possibilities, and introducing Pay Credit. So, Paymentology recently launched Pay Credit, designed to solve many of the blockers that we're discussing here today. Rob, for those hearing about it for the first time, please tell us, what is Pay Credit?
Okay, so first I'll explain what it is. PayCredit is a modern advanced credit ledger. And what does that really mean, especially in the context of what we've been talking about? Our aim here, and we had a blank sheet of paper when we started with this, was to build a credit ledger platform that basically frees our clients' businesses from all the complexity of this credit infrastructure and all the regulatory compliance. So we built a platform that already has that capability. But we also knew, as we've been talking about, the whole idea is we need to give our clients the flexibility to create different credit programs which meet different customer requirements. And we know that they're going to evolve those programs. So we developed it from the beginning to make it easy to launch different programs, to amend them, bring them quickly to market. And the third leg was we really appreciate this is a customer's perspective. What do we really want customers to achieve out of it? So actually, we need to allow them to launch products which actually fit those customer needs. So, for example, in installments capability, as I mentioned earlier on, you've got to give them the choice about what different installment options might be available. But once they've got those installments, to say, actually, you can amend that. You can change it to suit your different customer segments. And the end result here is we were very much said, this is a product which is enabling our clients to make better engagement with their customers.
Yeah. I must say, it's every time we talk about PayCredit, everyone's eyes just light up because I think this is what the industry and the market has really been waiting for. Rob, I want to understand from you, what use cases most excite you about, PayCredit when it comes to installments or salary-linked credit, embedded lending, like we're talking about micro SME credit cards. We're also hearing about stablecoin backed credit cards. There's so much. What really excites you about these use cases?
I have to say it's almost all of the above.
Yeah.
Because there are so many different cases. In fact, I'll pick one that hasn't come on the list, or maybe on a list somewhere, is actually credit building applications. And this is quite an interesting angle on this, because once upon a time, you could say almost credit cards got a slightly bad image. People can get into debt if they don't manage things carefully. So businesses are actually launching cards almost for the opposite. So actually, it's going to start with a low limit, low capability, but basically it's helping the end customer build a credit history. And that credit history is a key thing they want. So moving beyond into different aspects of credit, they want to try and get a mortgage for a house. That can be very difficult if you don't have the history. You've moved to a country, you don't have a credit history there. So organizations are launching products to enable this group of customers to access something they previously probably couldn't access. That is great. And in engaging with them, what we're saying, well, it's really the same platform from our point of view, but ours is a really interesting use case. We can launch this easily. It's got slightly different features to other organizations, but it helps them manage their customer achieve what they want to do. The other one I'd say you have mentioned there is, and is quite close to my heart, is around installments, but it's really about helping the customers manage their finances. It's actually avoiding people really trying to get into trouble where they're building up a debt that they're going to struggle with. It's actually really the opposite, to say, and even in those areas, although you might think credit cards are quite expensive, actually managed in this way, it could well be better off for you than having, let's say, an overdraft with a bank, which you're not managing to clear. And overdraft fees build up the same as anything else over a period of time. And actually, you've given the customer the choice and they allow them to flex that installment. And I think that's a really important capability.
It's brilliant. And honestly, telling you from a person who's moved to the UK and not having a credit history here, this is music to my ears. It really is. And what I also love about PayCredit is the optionality. Customers can choose between BNPL, installments, and then full-blown credit. And Rob, I think that is so important when it comes to like emerging markets as well, because like we've been talking about, building up this credit history is absolutely critical to, succeeding in the credit world, right?
Yeah. But there's also a lot of variance across the markets. That's one of the things. We're a global company, so we operate all around the world. And credit does vary around the world. It varies. Regulatory requirements are always a bit of a challenge. So that's something we support our customers with. But actually, a local arrangement. So, for example, in Mexico, there's a local installment loan capability, which is triggered by the merchants. And gives the customers opportunities, particularly is driven by events, to say, okay, there's an event coming up, a national event. You can now take part of offers which are there. And so we need to enable those offers. And as it's installments, and in certain other countries, maybe there's regulatory requirements, particularly around things like Islamic credit. But at the end of the day, we want to enable these services, and it all comes back to the customer.
Yeah.
So actually, they can use this product. It makes them easier to manage their finances.
Absolutely. And I think it also goes back to what we were talking about around, future proofing and that configurability piece, right? And that's how you've really built it out.
Yes, that is. And at the core of it is also putting our clients in a position where they get to make some of those decisions themselves. So it's not just they have to come to us, we configure the product. As you said, in the old days, maybe it takes a few weeks. Actually, they can do that themselves. We can empower them to drive that, whether it's through online portal, they can go in and make those configuration, but they can also drive configurations out of API calls as well, which means that actually they can get to a point where they can even treat their customers differently. So one customer can have an installment loan for one reason, and a different one could have actually a different requirements and different loan.
And I mean, that is what I think is so exciting. The fact that digital banks can actually test it out before they roll it out, right? And they can have the continuous innovation and see how the market is going to react, how a customer is reacting, or like you said, Rob, that segmentation. So different configurations for different segments.
Yeah, exactly.
Going back to hyper-personalization, right?
Yes.
David, which new credit segments do you see growing the fastest?
There's really two that I've noticed and I'm hearing more, card issuers talk about, and this may not be a surprise to anyone. One is commercial and business, right? That is a segment that's growing very well. It can be very, very profitable. And so that's one area. The other is the more affluent premium card products. You're seeing a lot more metal card, you're seeing a lot more travel benefits, you're seeing a lot more, of these very premium benefits, often with an annual fee, although many times they give enough bonus points to offset that fee, but still a fee-based product that's premium. We're seeing a lot more of those, or a lot more of those programs launching, because especially economically, that segment, even as, maybe there are downturns, that segment is generally not impacted. And it's a very lucrative or a very appealing segment to a lot of card issuers. And so we're seeing more on the premium side. And then going back to what we've been talking about with all the functionality and features, we're seeing, you might think of a premium card product as being for some old, stodgy, wealthy person, but really nowadays it can be for someone who maybe isn't even wealthy and not old, right? Yeah. The younger audience is looking to premium cards as well. It's a status symbol in most cases, or it's just, it's just a product that makes them feel good about themselves. So you see, even as a premium card with an annual fee, you see someone that may or may not really need to be affording that, those annual fees, getting those type of products, because it comes with a lot of, not only benefits, but it just comes with that feeling like I finally made it.
Yeah,
right?
Status.
Yes, the status. And so we're seeing that premium segment grow because it's expanded beyond the wealthy consumers. So that's probably one area where I feel like we're going to continue seeing a lot of growth.
And I think that's exactly what we're seeing. Affluent customers, corporate expense management, credit cards. A very exciting one that we're also seeing is stablecoin backed credit, which is something that we obviously are really excited about and pushing heavily. I want to now look ahead. Let's look at the future of credit, because this is where it gets really exciting. David, if you project a few years out, what will modern credit mean to consumers? What innovations or shifts should digital banks be preparing for now?
So we've spoken a lot, about hyper-personalization, which is, kind of a buzzword, but really it's about, like Rob said, and we've been talking about, it's looking at what does an individual customer need and how can I automate those decisions? How can I automate those either perks or benefits or features in a way using the data in a very timely manner that is responsive to my client's specific needs and my cardholder specific needs, and that could be based on the type of transactions they're performing, or it could be based on other data that you're pulling in. So I think we're going to see more benefits and rewards and cash back being very personalized.
Yeah.
The other thing I think is that, and you talk about, or we've talked about, like who knows what's coming next, right? With innovations, Apple Pay was an example. In 6 months, there may be some new feature that everyone is excited about, and I think we'll start seeing, and this will be led by a lot of neobanks and challenger banks. We'll start seeing kind of looking to more than just financial services, to really looking at how consumers are behaving in a normal setting. How are they using their phones? What social media are they using? How are they communicating with each other? How are they moving money between each other, not just to make purchases? And I think, there will be very creative. I don't know what these are, right? I can't say for sure what's going to happen, but I believe that we'll start seeing a lot of creative ways to pull in everyday consumer behaviors into the credit card so that it's responsive not only to their needs, but also to it allows them to be the person that they want while still being a part of a group. We talk about hyper-personalization, but we also talk about a fluent card where, okay, this is me and this is what I am, but also I'm a part of this group.
Yeah.
So it's so exciting, and credit is so exciting and continuing to change and growing so quickly that predicting what's coming next is hard, but I think it will be based on real consumer behaviors, not just financial, but also their lifestyles and other things.
Absolutely. I think that is definitely why credit is, a hot topic right now, because it's allowing people to be creative with their finances. And that's why it's one of the reasons why it's so, so exciting. This is a pivotal moment in financial services when we look at credit. Rob, can I ask you, how do you see pay credit evolving? And what's your vision for the future of flexible, customer-centric lending?
Okay. Well, David's given a great intro to that, because a lot of it is around supporting how the market's going to evolve. So in that regard, it's a bit like, yes, within the products that our clients have launched, they've got a customer segment, but the ability to then say, okay, so all my customers fit in that group or this group of customers, but actually maybe I'm going to start varying some of them because yes, I've made these installment plan options available to them, or because we've got a cashback reward capability, but actually I might just start to personalize it a little bit more, slightly different variants. And the reason I'm going to do that is because it just suits this customer, what they're actually going to go through at the moment. So allowing the greater capability is definitely something we're doing. Yeah. We also, as I mentioned, we have this global footprint, and credit does vary. So this is also quite a key thing for us to say, okay, in Mexico, in Brazil, in Singapore, in Philippines, there are services launched, which means we'll just slightly vary our capabilities because we need to support our clients in different areas. But I think the last part I would say is that, similarly as David's introduced it, is the use of data. And that is enabling very much, I love the customer-centric view. So it's giving them access to data to say, okay, you're going to give you choice in terms of if you manage your finances in this way, it's going to cost you a little bit more. This is a good option for you. You could reduce the cost. But also enabling our clients to make better decisions. Because ultimately, they are running their businesses and they have their customer segments. So the more data we can provide to them to help them decide, actually, maybe this would be a good feature to launch. Oh, I've tried this feature and actually this isn't so good. Allowing them to amend it over time to suit as the market evolves is definitely a key thing for us.
Absolutely.
In the access to data analytics.
And there's two amazing things that you said there. So firstly, obviously the global footprint. And I think we just got back from an event and everything was think global, go local. But the reality is that is absolutely important, right? You have to have a local perspective when offering credit specifically because it is so heavily regulated, right? But you still want choice. The second is using the data to really, be intuitive to what customers need. Because I think, David, you said this earlier, customers don't often know what they need.
Right.
So it's up to us to say, this is the data that we're getting. This is how we are going to offer new products, new features, new services, which are all configurable. Yep. Right? It's a brilliant how it all just fits together. Unfortunately, we're getting to the last question. So from all of your experience, what is the one rule for creating credit products that stay simple, transparent, and are genuinely helpful to customers? David, we'll start with you.
Okay, great question. One single rule. I think for me, just based on, every year we do an annual consumer study at Datos, and every year it's something that I think is overlooked. The one rule is to make the application as simplified and as fast as possible. Simplified is, the minimal number of data points that need to be entered in. And if you can pull existing data points that you already know about that consumer into the application, even better. Fast application, fast approval, fast access to the card. That, I would say, that first 5 minutes, if you can, get a card in there, a mobile wallet that quickly, that first 5 minutes to me is the most critical of all. Consumers consistently say that a simple, fast approval is one of the top reasons they choose a credit card.
Brilliant. Simple, fast. Love it.
Simple, fast.
Rob?
That's a really great answer. I was struggling to think of another
Always worth to go second.
But what I would say is I think the next rule, if you like, would also be the launching that product that meets those customer needs. And this is really about the ongoing engagement. Because yes, I've launched a credit card, but if the customer's great, they've signed up, they've used it a few times, what you really need to do is to have something that matches their needs. And it may well be the rule is not just to match their needs, but to evolve as the needs go along. Because you're building a relationship with this client, the customer. You're not there for 1, 2, 3, 4 months, 1 year. This is something that's going to go on. And so the rule there is you've really got to understand the requirements and make sure you're meeting them, and you evolve with that solution to meet their evolving requirements.
Absolutely. That is critical. Understanding the customer needs and then meeting them. Because so often we understand the customer's needs, but we have no idea how to get there, right? And so that still creates a negative impact. But Rob, with Pay Credit and with the configurability, you're really solving that need.
That is our focus. That's what we want to do.
And that's a wrap on today's episode of the Issuer Academy. A huge thank you, David and Rob, for joining us. Join us next time as we continue exploring how technology, trust, and smart infrastructure are shaping the future of finance, one payment at a time. Catch you next time on the Issuer Academy. That wraps up today's episode of the Issuer Academy, Paymentology's podcast to innovate, scale, and provide impact. I hope you're leaving with fresh insights and actionable strategies to help you revolutionize your card programs and drive true impact in the world. If you've enjoyed today's conversation, please leave a review to help us reach more pioneers like you. Also, be sure to subscribe and follow us for more inspiring episodes and behind-the-scenes content from Paymentology. Until next time, I'm Merusha Naidu. Keep innovating, keep scaling, and keep striving to make an impact.